Hi, I'm Dr. Antonio Graceffo, and welcome to China Economic Research, coming to you today from Ulaanbaatar, Mongolia. Today's episode, China government's access to U.S. capital markets. There are around 700 Chinese companies in America's stock and bond or capital markets. China has about 86 companies listed on the New York Stock Exchange and about 62 in the NASDAQ, and over 500 in the over-the-counter market. Additionally, China earns hundreds of billions manufacturing and exporting goods to the United States. And by shipping through Hong Kong, they take advantage of the U.S.-Hong Kong Policy Act, which grants favorable tariff status to Hong Kong, bypassing the tariffs associated with the U.S.-China trade war. And this is all money that flows from U.S. consumers and companies into the pockets of the Communist Party of China. Money which the CCP uses to further its objectives. This is a recurring theme you'll be hearing a number of times in this and some of my other videos. By allowing China access to U.S. capital and trade markets, the U.S. is funding the CCP. Since June of 2019 and continuing until now, there have been pro-democracy protests in Hong Kong nearly every single day, which evoked a violent response from the Hong Kong police. Accusations have been made by protesters, foreign media, and other observers that the police have committed acts of excessive use of force, police brutality, rape, and murder. A dramatic increase in the number of suspicious suicides since the beginning of the protests have also suggested that the Hong Kong police or other agents of the Communist Party of China have been engaging in extrajudicial killings. The salaries for the Hong Kong police, as well as all the security forces of mainland China, are paid by the Chinese Communist government, which earns much of its money by exporting to the U.S. In the end, U.S. companies and U.S. consumers are funding and furthering the objectives of the Chinese Communist Party. Hong Kong is economically important to the CCP. Annual tax revenue is nearly $6 billion, and their trade with the U.S. accounts for another $6 billion. Beijing uses Hong Kong currency, equity, and debt markets to attract foreign investment from the U.S. and other countries. Foreign direct investment, FDI, is channeled through Hong Kong into mainland China. Most of China's largest state-owned enterprises have listed on Hong Kong exchanges as their first step toward global expansion and as a pathway to listing on U.S. exchanges. In 2018, Chinese firms raised $64 billion via initial public offerings, $35 billion of which came from Hong Kong. Through Connect schemes, U.S. and other foreign nations invest in mainland China companies using Hong Kong as a conduit. U.S. investment flowing into Chinese debt and equity markets reached $160.4 billion in 2018. Beijing uses Hong Kong debt markets for 33% of their $165.9 billion in offshore U.S. dollar funding. Hong Kong banks hold $1.1 trillion of China's reserves. Losing all of its various financial engagements with Hong Kong risks crippling the Chinese economy. As a direct reaction to Beijing's crackdown on Hong Kong's pro-democracy movement, the U.S. Congress has passed the Hong Kong Human Rights and Democracy Act, which calls for the U.S. to evaluate the human rights and democracy in Hong Kong each year. And if certain standards are not met, Hong Kong will lose its special tariff status. The U.S.-China Economic and Security Review Commission reports that as of February 2019, of the roughly 156 Chinese firms listed on U.S. exchanges, 11 are state-owned. 50% of Chinese companies listed on U.S. exchanges refuse to submit themselves to a full audit by the Public Company Accounting Oversight Board. And this list does not include Chinese companies that listed on U.S. exchanges via Hong Kong, the Cayman Islands, or some other country. So the actual number of Chinese companies on U.S. exchanges is much higher. Yahoo Finance reported that American shareholders were squeezed out by U.S.-listed Chinese companies. After tapping into U.S. capital markets through U.S. IPOs, the management of Chinese companies sometimes decides to take the firm private at a significantly cheaper valuation. Next, the same management takes the firm back to China, lists on a Chinese exchange, and has a Chinese IPO at a higher valuation. leaving insiders and executives with a big windfall and American investors with losses. Since 2013, nearly 60 U.S. listed Chinese companies have gone private. Peter Halsworth, manager of Hung Run Partners, told Yahoo Finance that they're just trying to squeeze every last drop of blood out of U.S. shareholders and then go on and relist and do a new IPO in Chinese markets for 3 to 5 times the transaction price in the U.S. This particular cheat is made possible by U.S. laws which allow these companies to list in the U.S. while being classified as foreign private insurers, FPIs. Rather than being subject to U.S. rules, FPIs are subject to regulations by their home country's exchange. They are also exempt from corporate governance practices which most publicly listed firms must comply with. And this includes not having to host annual shareholder meetings. The way the ownership is structured, the founder retains voting control, only selling minority interests to the public, making them powerless to reject a low-ball buyout offer for the company's shares. Many of these Chinese IPOs are from Chinese companies officially domiciled in the Cayman Islands, where protections for minority investors are even lower. If the minority shareholders try to sue, the defendants and all the records for the company are held in China, making the suit nearly impossible. NASDAQ is planning to reduce the number of IPOs of small Chinese companies because the shares of most small Chinese companies trade thinly following their U.S. listing. The shares are mainly sold to connections of the executives. Because so few people are trading them, the liquidity is low, which discourages others from investing in them. Another step NASDAQ is taking is to refuse listing companies which do not demonstrate a strong nexus to the U.S. capital markets. Those which have no shareholders, no operations, no management, or board members with links to the United States. Many of these Chinese firms wish to do an IPO in the U.S. Many of these Chinese firms wish to do an IPO in the U.S. as a way for the founders and initial investors to cash out their shares. The companies are built with RMB in China, but sold at a tremendous profit for US dollars in the United States. It is always difficult to move US dollars out of China, but during economic downturns, the controls become draconian. A US IPO is a way for a small group of Chinese businessmen not only to earn a profit and obtain dollars without facing exchange limits in China, but also a way of moving the money outside of China, bypassing China's capital flight restrictions. Furthermore, back in China, listing on NASDAQ is a feather in the company's cap, which can be used to convince investors and lenders in China to fund them. Also, U.S.-listed Chinese companies find it easier to obtain China government subsidies. In the U.S., the spirit and even the law of publicly traded companies is that they should act in the best interest of the shareholders, taking decisions which maximize shareholder value. These companies are acting in the interests of a core of executives and owners while disregarding both the rules and the minority investors. Since 2000, Chinese firms have earned $70 billion in the U.S. stock market. On average, Chinese IPOs that raised $200 million in their IPO have traded down 38%, as opposed to U.S. companies of the same size whose shares increase in value by an average of 13.9%. China often finds ways of skirting U.S. rules by creating opaque systems of shadow ownership and control. The use of variable interest entities, for example, allows Chinese state-owned companies to list on U.S. exchanges via an affiliated foreign company that operates through a contract rather than direct ownership. These companies obtain their funding from U.S. individuals, pension funds, and institutional investors. While many of them are state-owned or state-controlled entities, all of them could be called upon to work for the Communist Party of China. Article 7 of the National Intelligence Law of China requires all Chinese companies and citizens to aid the Communist Party in intelligence gathering, including espionage and technology theft. Money that is going directly from U.S. investors to the Communist Party of China would include the billions of dollars worth of China government bonds now being purchased by U.S. investors. Chinese Renminbi government and policy bank bonds are included in the Bloomberg Barclays Global Aggregate Index. And JP Morgan Chase & Company added Chinese bonds to its Government Bond Index Emerging Markets Index. In February 2020, it was announced that JP Morgan had added 9 eligible Chinese local government bonds capped at 10% of the Government Bond Index Emerging Market Global Diversified and Narrow Diversified Indexes. Analysts estimate that a total of $20 billion in U.S. funds may be channeled into the Chinese bond market. In 2019, amidst the U.S.-China trade war, Chinese foreign direct investment into the U.S. decreased by more than 80%, hitting $5 billion, while American investment in China only decreased by about 7%, reaching $13 billion. Therefore, in 2019, U.S. firms invested more into China than China invested in the U.S. In terms of venture capital investment, U.S. firms invested $19 billion in Chinese startups. But under Chinese law, they could only take minority stakes in these firms. So the U.S. shareholders would not have majority voting rights and would have very little control over the actions taken by those firms. And as stated earlier, under Chinese national intelligence and national security law, these firms using American money are obligated, when called upon, to act on behalf of the Communist Party of China, helping Beijing to achieve its global objectives.